Okay, let's unpack this. You've sent us, well, quite a stack of incredibly rich material here. It's all centered on related services within, the dynamic world of auditing and financial reporting. And your mission, should you choose to accept it, is to utterly ace an upcoming case-based exam. So this deep dive, it's custom tailored just for you, the learner. Consider it your shortcut to being not just well-informed, but expertly prepared to apply this knowledge. We're going to distill every key concept from the bare standards, use the exact language, the terminology you'll see on the exam, and put it into real-world scenarios, including a full-blown case study later, so you can apply this knowledge effectively and, deeply understand it.
Indeed. And what's truly fascinating here, I think, is how related services carve out their own unique space. They're quite distinct from, say, traditional financial statement audits or even reviews. Our goal today is really to equip you not just with what these services are, but critically why they exist, how they function in practice, and most importantly, how to critically think about them for your exam. We'll be pulling directly from the standards on related services, or SRS, specifically SRS 4400 and SRS 4410, making sure you get familiar with the precise terminology and context that will be tested. It's all about precision and nuanced understanding here.
Right. So think of us as your expert guide through this, often misunderstood terrain. We'll navigate the foundational definitions, delve into the ethical considerations, explore the intricacies of performance, and especially demystify those crucial reporting requirements. Okay, let's dive in. First up, let's get a fundamental understanding of what we're actually talking about. What are related services? Our source material makes it clear right away. These are professional services that chartered accountants in practice frequently provide to clients, which, and this is the absolutely crucial distinguishing factor, do not involve the expression of an opinion on the truth and fairness of the financial statements. So right off the bat, we're putting a clear fence between these and a standard financial audit.
Yes, and this immediately raises a really critical question. Why bother creating separate standards for these types of engagements? Why not just, lump them under existing audit standards or maybe just leave them unregulated? Well, imagine the chaos if every practitioner just kind of winged these non-assurance engagements without common guidelines. Without clear standards like SRS 4400 and 4410, you'd have, inconsistencies in methodology, documentation, the understanding of responsibilities. It'd vary from firm to firm. And this could lead to widespread misinterpretations by users of the compiled info or factual findings, potentially damaging the public's trust in the entire accounting profession, really. These standards aren't just a set of rules. They are the bedrock of reliability and consistency for non-assurance services, ensuring a baseline of professional conduct and output. They bring order, you see.
That makes a lot of sense. So if related services explicitly don't involve an opinion on financial statements, where exactly does the definitional boundary lie? Like, if a practitioner provides some level of comfort or credibility to a client, how do they know they haven't accidentally crossed into what's known as an assurance engagement? Because that's a term that comes up a lot here, often is the key point of comparison.
That's a truly insightful question, and it gets right to the heart of the matter, actually. An assurance engagement is formally defined as an engagement where a practitioner expresses a conclusion designed to enhance the degree of confidence of the intended users. And those users are individuals or entities other than the responsible party. That's key. About the outcome of the evaluation or measurement of a subject matter against criteria. Phew, okay, in simpler terms. It's where the practitioner provides an opinion or a conclusion about specific information or a process, such that the chance of that information being incorrect or the process being flawed is significantly diminished. This allows users to make more confident, informed decisions based on that assessed information. It's about providing a level of comfort or credibility, where the practitioner is directly taking a stance on the reliability of the subject matter.
And to be absolutely crystal clear for the exam, related services are explicitly not assurance engagements, correct? It's a crucial definitional boundary we need to firmly grasp.
Precisely, yes. The source material is very explicit here. It lists examples of engagements that do not meet the definition of assurance engagements. These include, say, routine preparation of tax returns, where no conclusion conveying assurance is expressed, various consulting or advisory engagements, think management consulting or basic tax advisory, and most crucially for our deep dive today, engagements specifically covered by the standards for related services. This last category specifically includes agreed-upon procedures engagements, statements, which we'll get into next, and compilations of financial or other information. Understanding what falls outside the realm of assurance is just as vital for your exam as knowing what falls within it. Related services carve out their own specific space where the practitioner's role is different, and the output does not carry an assurance conclusion. This distinction is paramount, both for practice and for the exam.
That's a superb foundational setup. Really clear. Now let's kick off with the first distinct type of related service. Agreed upon procedures, often abbreviated as AUPs. These engagements are meticulously covered by SRS 4400. To set the stage, let me present a scenario directly from our source material that perfectly illustrates this. Trends, Multi-Products Limited, engaged in selling ethnic items with huge inventories at multiple locations, requests C.A. Sean to undertake an exercise involving physical verification of inventories and its reconciliation with inventory records for a handsome professional fee. End quote. Now, on the surface, this sounds a lot like an audit procedure, doesn't it? But it's emphatically not an audit. This is where it gets really interesting.
Yes, it's fascinating because while C.A. Sean might initially think of SA 501, that's the standard on auditing for audit evidence on inventory in a financial statement audit, the core objective of an agreed-upon procedures engagement is distinctly different. The purpose, as stated right there in SRS 4400, is for the auditor to carry out procedures of an audit nature, to which the auditor, the entity, and any appropriate third parties have explicitly agreed, and then to report solely on factual findings. The key phrase here, and I cannot stress this enough for your exam, is factual findings. No assurance is provided whatsoever on the subject matter itself. Instead, the users of the report. They're expected to assess these factual findings themselves and draw their own conclusions. This is a critical distinction from an audit, where the auditor gives an opinion.
So it's about executing very specific procedures that have been pre-agreed upon, rather than forming a broad opinion on the overall financials or even the specific account balance. The report is almost like a detailed eyewitness account, like you said, but without the eyewitness giving an opinion on what happened overall. How does this compare directly to a full-blown audit then, beyond just the opinion part?
You've hit on the core difference with that analogy. Exactly. The key difference relates directly to the concept of assurance and the nature of the conclusion. An audit expresses an opinion, right? It provides a high level of assurance to users, enhancing their confidence in the financial information as a whole. In stark contrast, an agreed-upon procedures engagement, it only provides a report of the factual findings. No assurance is given to the users by the practitioner. None. It is solely incumbent upon the users themselves to draw their own conclusions based only on the factual findings stated in the report. For example, the source gives a practical scenario. If an AUP engagement involves accounts payable, the auditor might agree to, say, compare supplier names and amounts to the trial balance, get supplier statements or confirmations, and then compare these back to the trial balance. The report would not state whether accounts payable are fairly presented or valid. No way. It would simply state the factual findings. Something like, we noted variations in balances reflected in the trial balance and supplier statements for vendor A and vendor B, amounting to X and Y, respectively. Or maybe list specific exceptions found during the comparison. This direct example helps in understanding the practical application. It's about transparency of the procedures performed and the exact outcomes, not an auditor's judgment call on overall validity or fairness. The risk, the responsibility for conclusions, that rests with the users.
That makes the distinction crystal clear. But what about the ethical side of things? Does C.A. Sean still need to adhere to ethical principles and, perhaps more pointedly, be independent when performing an AUP engagement? It's almost counterintuitive for someone ingrained in audit principles where independence is, the holy grail. How challenging is it for a CA to mentally switch gears for an AUP engagement?
It's an excellent point, and often a conceptual hurdle for practitioners, absolutely. The auditor must comply with the Code of Ethics issued by the Institute of Chartered Accountants of India. That's non-negotiable. For any engagement undertaken by a chartered accountant, including AUPs. The fundamental ethical principles that govern the auditor's professional responsibilities for this type of engagement include integrity, being straightforward and honest, objectivity, not allowing bias to override professional judgment, professional competence, and due care maintaining expertise and diligence, confidentiality protecting client information, professional conduct complying with laws and regs, and technical standards performing services according to the standards. However, and this is crucial for your exam distinction, independence is not a specific requirement for agreed-upon procedures engagements, unless the terms or objective of the specific engagement explicitly require it. This is a significant deviation from an audit. If for any reason the auditor is not independent, a clear statement to that effect must be made in the report of factual findings. This reflects a key difference in emphasis compared to a full audit, where independence is a cornerstone requirement. For an AUP, the reliance is on the factual findings, not an opinion backed by independence.
All right, so if C.A. Sean accepts this type of engagement, what exactly needs to be nailed down up front? Imagine an engagement letter comes into play, much like in an audit, but with unique AUP specifics, right?
Indeed, yes. Defining the terms of the engagement clearly is absolutely paramount to avoid any misunderstandings down the line. The auditor should ensure a clear understanding with the entity and, ordinarily, any other specified parties who will receive copies of the report. This understanding is typically documented in an engagement letter. Think of it as the contract and scope definition. Matters that absolutely must be agreed upon include, first, the nature of the engagement. Explicitly stating that the procedures performed will not constitute an audit or a review, and thus, crucially, no assurance will be expressed. Manages expectations right away. Second, the stated purpose for which the engagement is being undertaken. Why are we doing this? Provides context. Third, precise identification of the financial or non-financial information to which the agreed-upon procedures will apply. Is it specific accounts, individual items, or a whole set of statements? Scope needs to be narrow, precise. Fourth, the nature, timing, and extent of the specific procedures that are to be applied. This defines the exact work, leaves no room for ambiguity. And finally, any limitations on the distribution of the report of factual findings. Because no assurance is given, the report's only relevant to those who agreed to the procedures and understand its limitations. The engagement letter serves to document these key terms, confirm the auditor's acceptance, and helps avoid any future misunderstandings. It's really the blueprint for the engagement.
Okay, blueprint set. Once all those terms are agreed upon and documented, what kind of procedures would C.A. or Sean actually perform to gather these factual findings? You mentioned procedures of an audit nature. Could you give us some concrete examples of what that looks like in an AUP?
Absolutely. The procedures applied in an AUP engagement are indeed often, as the standard says, of an audit nature. But remember, they are specifically agreed upon beforehand with the engaging parties. They aren't chosen by the practitioner based on risk, but by agreement. These agreed-upon procedures may include a range of techniques to gather the factual findings, designed to be objective and verifiable. The source material lists several common examples you frequently see. Things like inquiry and analysis, which means, asking questions of management and staff, and reviewing information to understand relationships and patterns. Then there's recomputation, comparison, and other clerical accuracy checks. Pretty straightforward verifications of calculations, cross-referencing data, checking math. Also observation, where the practitioner directly witnesses a process or activity, like watching an inventory count. Another common one is inspection, which involves physically examining records, documents, or tangible assets, like inspecting a machine to confirm it exists. And finally, obtaining confirmations, where you seek information directly from third parties, like confirming bank balances with the bank, or AR balances with customers. These are the practical tools used to execute the agreed-upon scope and gather the necessary factual findings. They're objective actions, not subjective judgments.
And then the report itself, this is the final output, the deliverable of the AUP engagement. What's absolutely essential to include in this report are factual findings to ensure it meets SRS 4400 requirements and stands up to exam scrutiny. What are the non-negotiables, the absolute must-haves that C.A. Sean needs to get right?
Right, this is a high-yield area, absolutely critical for your exam. Think of the report as your official communication of what you did, and perhaps more importantly, what you didn't do. It must be detailed enough for any reader to clearly understand the specific work performed without any ambiguity. So naturally, you start with a clear title, something like Report on Factual Findings, and the designated addressee, usually the appointing authority or the parties who agreed to the procedures. Then comes the precise identification of the specific financial or non-financial information the procedures apply to, whether it's a list of accounts, specific transactions, whatever it is. A crucial point follows. A statement that the procedures performed were those agreed upon with the recipient. Reinforces that limited scope. You must also include a statement that the engagement was performed in accordance with the standard on related services applicable to agreed-upon procedures engagements, meaning SRS 4400. That's the professional framework. Then, identification of the purpose for which the procedures were performed. Why was this work requested in the first place? Following that, a detailed listing of the specific procedures performed. This is paramount. It clearly defines the exact work done, forms the basis for the findings, and of course a clear description of the auditor's factual findings, including sufficient details of any errors, exceptions, or observations found. This is the core output, the meat of the report. Now, here's the clincher, the part that screams related service and not audit. An explicit statement that the procedures performed do not constitute either an audit or a review, and as such, no assurance is expressed. Without that, you're just asking for misinterpretation. And, accompanying that, a statement that had the auditor performed additional procedures, an audit or a review, other matters might have come to light that would have been reported. Manages expectations about scope and limitations. Finally, a statement that the report is restricted to those parties that have agreed to the procedures to be performed, as others might misinterpret the findings, given the lack of assurance. And when applicable, a statement that the report relates only to the specified elements, accounts, or items and does not extend to the entity's financial statements taken as a whole. Then you wrap it up with the date of the report, the place of signature, and the auditor's signature. Mastering these elements, absolutely key to demonstrating a strong understanding of SRS 4400 and avoiding any misrepresentation.
Okay, let's put this into an exam-style application to really solidify those reporting requirements. The source provides a test-your-understanding question. A company asks you to carry out process of confirmation of its accounts receivables having balances in excess of 10 lakhs. The work to be performed only involved preparing and sending confirmation requests, analysis of variations on receipt of confirmations, and submission of a report in accordance with professional standards. What points have to be kept in mind for inclusion in reports specifically for such engagement? How would you approach this? Connecting it back to the detailed requirements we just discussed. Make sure we hit every exam point.
Right, good example. Based on our comprehensive discussion of the SRS 4400 reporting requirements for this specific AUP engagement focusing solely on accounts receivables over 10 lakhs, the report absolutely needs to cover several key points precisely. Firstly, it must clearly state that the procedures performed were those agreed upon with the recipient of the report, emphasizing that predetermined scope. Secondly, it needs to explicitly mention that the engagement was performed in accordance with SRS 4400, the specific standard for AUPs, anchors the work. Thirdly, the precise purpose of the procedures must be identified, in this case confirming AR balances over 10 lakhs. Fourth, a precise and exhaustive listing of the specific procedures performed is essential. Preparing sending confirmations, analyzing variations on receipt, spell it out. Fifth, a detailed description of the factual findings should be included. Outline any errors or exceptions discovered, specific unconfirmed balances, significant variations, discrepancies noted, like, we noted customer XYZ's balance of 12 lakhs was confirmed as 10 lakhs, a variation of large 2 lakhs. Be specific. Crucially, the report must contain that clear statement that the procedures performed do not constitute either an audit or a review, and consequently, no assurance is expressed regarding the AR or the financials as a whole. Non-negotiable. Furthermore, the disclaimer is required. Had the auditor perform additional procedures, an audit, or a review, other matters might have come to light. Manages expectations. Lastly, it must clearly state that the report is restricted to those parties that have agreed to the procedures and that it relates only to the specified AR, not the entity's financials as a whole. Prevents misuse. Nailing these points demonstrates a thorough, comprehensive understanding of SRS 4400 reporting in a practical context. Vital for your exam.
Excellent breakdown. That level of detail is exactly what our listener needs for their exam. Perfect. Now let's pivot to the second distinct type of related service. Compilation engagements, which are governed by SRS 4410. Our source material opens this section with another compelling scenario. C.A. Sean, sitting in his air-conditioned office in Kolkata, is approached by a client to help it prepare its financial statements. The client is agreeing to provide trial balance and other required information, but also requires a compilation report. This feels fundamentally different from the inventory verification AUP, doesn't it? Here the focus isn't on performing procedures, but more on assembly and presentation.
Absolutely. It's a distinct realm, almost a different mindset, yes. A compilation engagement is specifically defined as an engagement where a practitioner applies accounting and financial reporting expertise to assist management in the preparation and presentation of financial information of an entity in accordance with an applicable financial reporting framework and issues a report. The core here is assistance in preparation and presentation, rather than performing specific procedures to report factual findings or expressing an opinion. It's essentially an application of the practitioner's expertise to create or assemble financial information in a structured, compliant manner, a different kind of support to management. You're helping them get their financial ducks in a row, so to speak.
So if the practitioner is assisting in preparation, does that mean they don't verify the accuracy or completeness of the information provided by the client? And there's certainly no audit opinion given, correct? That's fascinating because for many, the very idea of an accountant working with financial info without verifying its accuracy just feels counterintuitive. What does this mean for the user of a compilation report? Are they just expected to take the information at face value?
You've hit on a common misconception, and it's a crucial distinction, one you must grasp firmly for your exam. The source explicitly states, a compilation engagement is not an assurance engagement. That's the bedrock principle. What this means in practice is that the engagement does not require the practitioner to verify the accuracy or completeness of the information provided by management for the compilation, or otherwise to gather evidence to express an audit opinion or a review conclusion on the preparation of the financial information. The practitioner is largely relying on the information provided by management, so for the user. It means they should understand that the information in the compilation report has not been independently verified for accuracy or completeness by the practitioner. They are expected to take the information at face value as presented by management, with the understanding that the practitioner's role was to assist in its format and presentation according to a framework, not its underlying truthfulness. The report itself will clearly state this limitation, so users are definitely informed about the limited scope. It defines the very limited nature of a compilation.
And its applicability seems broader than just historical financial statements, doesn't it? I recall the source mentioning other types of information beyond just past performance.
Indeed, yes. While a compilation engagement primarily applies to historical financial information, for financial data from past transactions and events, SRS 42410 is designed to be highly adaptable. It can be applied with necessary modifications and disclosures for compiling, for instance. Firstly, financial information other than historical financial information, a prime example. Prospective financial information, like budgets, financial forecasts, and projections. A company might need a practitioner to compile a detailed budget for next year based on management's assumptions. Secondly, it can also be adapted for non-financial information. While maybe less common, this could involve compiling operational stats, production reports, or environmental performance data, as long as it aligns with some specific framework or criteria for presentation. This flexibility means a practitioner can assist management with a wide range of information prep and presentation tasks under this standard. Goes beyond just the traditional historical financials. Speaks to the versatility of the CA's expertise, really.
Why would a company specifically need or request a compilation engagement then? What are the practical purposes behind it, particularly given its limited scope compared to an audit or review?
Well, the purposes for undertaking a compilation engagement are quite varied. They're driven by different practical needs where formal assurance isn't required or, frankly, desired. One primary reason is to comply with mandatory periodic financial reporting requirements established in law or regulation. For instance, many smaller entities might not be legally required to have an audit or review, but they still need professionally prepared financial statements for their annual filings. A compilation can fulfill this need economically. Beyond regulatory compliance, compilation engagements are also sought for purposes unrelated to mandatory financial reporting. These can include, first, for internal use by management or those charged with governance. They might need structured financial info for internal decision-making, performance monitoring, or communicating with the board. A compilation ensures a consistent, organized format. Second, for periodic financial reporting for external parties under a contract or agreement. A classic example is providing financial info to a funding body for a grant or to a bank for loan covenant monitoring where a full audit isn't stipulated, but some professional preparation is preferred. And third, for transactional purposes like supporting changes to ownership or financing structure. During M&A or when seeking new investors, specific financial presentations might be needed, and a compilation can efficiently provide this structured info without the higher cost and time of an audit. So it highlights the practical utility and versatility in various business contexts where professional presentation is needed, but not formal assurance.
Even though you're providing assistance in preparing the statements, the source stresses that management still holds the ultimate and full responsibility for the financial information, right? That's a key point to emphasize given the practitioner's involvement.
Is this paramount? Yes. A distinction that cannot be overstated for your exam. Management retains full and ultimate responsibility for the financial information and the basis on which it is prepared and presented. The practitioner's role is to assist, providing expertise in applying the applicable financial reporting framework. But the accountability and ownership of the financial information remains squarely with management, always. This covers management's responsibility for applying the judgment required for prep and presentation, including selecting accounting policies and, where needed, developing reasonable accounting estimates. The practitioner provides expertise and support, but the core decision-making and ultimate accountability, that resides with the entity's management. This must be clearly agreed upon in the engagement terms to avoid any ambiguity. Management needs to fully understand their role. It's fundamental.
Speaking of engagement terms, what specifically needs to be agreed upon before accepting a compilation engagement? It sounds like there are quite a few critical points, similar to how we detailed it for AUPs.
Absolutely. Before accepting a compilation engagement, the practitioner must reach a clear understanding and agree on several key terms with management and the engaging party if different. These agreed-upon terms are critical and should be recorded in an engagement letter or other suitable written agreement before starting the work. That letter is your protective shield, really. The matters to be agreed upon include, firstly, the intended use and distribution of the financial information, plus any restrictions on use or distribution, determines the audience. Secondly, identification of the applicable financial reporting framework. Is it Indian GAAP, Ind AS, IFRS, or maybe a special purpose framework? Got to know the rules of the game. Thirdly, the specific objective and scope of the compilation engagement. What exactly are we compiling? For what period? Fourth, the responsibilities of the practitioner, explicitly including the requirement to comply with ethical requirements and SRS 4410. Outlines the practitioner's duties. Fifth, and this is very detailed, the responsibilities of management. This is extensive and includes their responsibility for the financial information itself, its prep and presentation under the framework, the design, implementation, and maintenance of internal control needed to prevent material misstatement. Remember, the practitioner doesn't audit controls here. The accuracy and completeness of all records, documents, explanations, and other information provided the practitioner relies on this. And all judgments needed in the preparation and presentation, even those the practitioner might assist with. Management owns the judgments. Finally, the expected form and content of the practitioner's report must also be agreed upon. Documenting these terms thoroughly ensures clarity, prevents disputes, and clearly defines who's responsible for what.
So once all that's agreed and documented in the engagement letter, how does the practitioner actually perform the compilation engagement? What are the practical steps involved, especially since they're not verifying accuracy?
Right. The performance, despite being non-assurance, involves a structured and diligent process. It's not just data entry. Firstly, the practitioner must obtain an understanding of the entity's business and operations, including its accounting system and records. This is crucial even if you're not auditing. You need context. You also need to understand the applicable financial reporting framework and its specific application in the entity's industry. Secondly, the practitioner then compiles the financial information using the records, documents, explanations, and other information, including significant judgments provided by management. This is the core task, taking raw data, structuring it. Thirdly, they discuss significant judgments with management, especially anywhere assistance was provided during compilation. Ensures management takes ownership. Fourth, prior to completing the engagement, the practitioner reads the compiled financial information in light of their understanding of the entity and the framework. Does it look reasonable? Is it overtly inconsistent with what I know about the business? Fifth, and this is where professional skepticism still plays a role, even here. If, during the engagement, the practitioner becomes aware that information provided is incomplete, inaccurate, or unsatisfactory, they must bring that to management's attention and request corrections or additional information. You can't just compile known bad data. Now, if the practitioner is unable to complete the engagement because management fails to provide requested information, they shall withdraw from the engagement and inform management and those charged with governance of the reasons. Similarly, if the practitioner becomes aware that the compiled information doesn't adequately describe the framework, needs amendments to not be materially misstated, or is otherwise misleading, they shall propose appropriate amendments to management. And if management declines to permit these amendments, the practitioner shall withdraw and inform management and governance of the reasons. If withdrawal isn't possible, maybe due to legal constraints rare, but possible, the practitioner must then determine their professional and legal responsibilities. This highlights the ethical imperative. You cannot be associated with misleading info. Finally, the practitioner must obtain an acknowledgement from management that they take responsibility for the final version of the compiled financial information. So it's a comprehensive process, ensuring diligence and addressing potential issues.
That's a very clear outline of the performance process, especially those ethical responsibilities if information seems problematic. Very important. Now let's talk about the final output, the practitioner's report for a compilation engagement. How does it differ from the AUP report we discussed, and what are its essential components? What's the one thing it absolutely must communicate to its users?
Okay, the practitioner's report for a compilation engagement. It has a distinct purpose and content, quite different from an AUP report. Its primary function is to clearly communicate the nature of the compilation engagement and the practitioner's role and responsibilities. Crucially, and this is the one thing it absolutely must communicate, it is not a vehicle to express an opinion or conclusion on the financial information in any form. Unlike an audit or review, it manages expectations, Full stop. Key elements that must be included are: first, a clear report title and the addressee. Second, a clear statement that the practitioner has compiled the financial information based on information provided by management. Sets the context immediately. Reliance on management. Third, a detailed description of management's responsibilities, as we just covered, and the practitioner's responsibilities, including SRS 4410 and ethical compliance, clarifies accountability. Fourth, identification of the applicable financial reporting framework and the financial information itself, titles, dates. Tells the user the rules and the documents. Fifth, a general description of what a compilation engagement entails according to SRS 4410. Educates the user. Sixth, and vitally for your exam, explicit explanations that it is not an assurance engagement, no verification of accuracy or completeness is required, and no audit opinion or review conclusion is expressed. This is the core disclaimer. Protects the practitioner, informs the user. Seventh, if a special purpose framework is used, an explanatory paragraph describing its purpose and stating it may not be suitable for other uses. Finally, the date of the practitioner's report, signature, and place of signature. This report effectively manages user expectations by clearly outlining what was done and, maybe more importantly, what was not done. Gives credibility to the presentation without assuring the underlying data.
Let's apply this with another exam-style scenario from our source material. Seems like a good test. During the course of performing a compilation engagement under SRS 4410, it becomes known to you the client had suffered a theft loss of 2,000 lakhs. A claim was lodged, which was repudiated. The client has not preferred a complaint or an appeal against said repudiation. The amount is reflected under the head Current Assets and Trial Balance. Discuss how you should proceed to deal with the matter. This seems like a critical test of understanding the practitioner's ethical responsibility in a non-assurance setting.
It is indeed a classic misleading information scenario. Directly testing your understanding of SRS 4410's requirements when the compiled info is problematic. Since the over 100 lakhs insurance claim was repudiated and the client hasn't appealed, that amount is definitively a loss. It's not a current asset. The probability of recovery is, well, 0. Therefore, the financial information would be materially misstated if it remains under current assets. It presents a picture that is factually incorrect and, frankly, misleading about the entity's true financial position. In such a situation, the practitioner's responsibility is clear and ethically driven. They shall propose the appropriate amendments to management to correct the misstatement and ensure the financial information is not misleading. This might involve reclassifying the amount as an expense or a loss and adjusting current assets accordingly. Now, if management declines to make or doesn't permit the practitioner to make these proposed amendments, the practitioner shall withdraw from the engagement and inform management and those charged with governance of the reasons for withdrawing. This is a non-negotiable step. You have to avoid being associated with misleading financial information. Furthermore, if withdrawal isn't possible due to specific legal or professional obligations, again, rare but possible, the practitioner must then determine their professional and legal responsibilities in those specific circumstances. Maybe seek legal advice, report to authorities if required by law. This case really highlights the ethical imperative to prevent the issuance of misleading financial information, even in a non-assurance engagement like a compilation. Upholds that fundamental principle of integrity. You just can't knowingly allow misleading info under your professional banner.
Now, let's put it all together with an integrated case scenario, exactly the kind of thing you might face in your exam. KLM Limited has engaged your firm for compilation of financial statements under SRS 4410 for internal use. During the engagement, several issues pop up. Let's break them down, apply everything we've discussed, and decide the most appropriate action for each one. Ready?
Ready, let's tackle it.
Okay, issue 1. There are apparent errors in few opening balances. These have been swapped with some other balances. No credit transactions in such incentive accounts or accounts whose balances have been swapped during the year. What's the most appropriate action here? Your options are: A, such errors should straightaway lead to the qualification of a report to be issued. B, such errors should be brought to the knowledge of management. C, knowledge of such type of errors has no effect on compliance of ethical requirements by the firm. D, the above said matter relates to SA 510 initial audit engagements opening balances and has no effect on reporting obligations in a compilation engagement.
Okay. This scenario clearly points to inaccuracies within the information provided by management. Now, in a compilation engagement, remember, while the practitioner is not required to proactively verify accuracy, if they become aware that the records, documents, or info are incomplete, inaccurate, or unsatisfactory, as these swap balances clearly indicate, they shall bring that to the attention of management and request the additional or corrected information. It's a fundamental professional responsibility. So, option B, such errors should be brought to the knowledge of management is definitely the most appropriate action. Options A and D are incorrect because qualification of a report, or referring to SA 510 initial audit engagements, are concepts specific to audit engagements, not compilations. A compilation report doesn't offer an opinion to qualify. And option C is incorrect because knowingly compiling or ignoring inaccurate information would affect compliance with ethical requirements, specifically integrity and professional competence. So it's B.
Got it. Makes sense. Issue 2. One of the team members suggests that it is one of the duties to ensure that revenue figures stated in trial balance, at least, are verified to ensure that all revenues required to be booked by the company have, in fact, been booked. Is this suggestion appropriate? The options are: A. Suggestion of team member is proper as such verification is part and parcel of such an engagement. B. Suggestion of team member is proper as the absence of such verification may make financial statements misleading. C. Suggestion of team member is not proper as verifying the accuracy or completeness of the information provided by management is not required in such engagement. D. Suggestion of team member is not proper as compliance with qualitative requirements is not required in such engagement.
Right. This question goes directly to the core nature of a compilation engagement. It's a common trap in exams, this one. As we've hammered home, a compilation engagement is not an assurance engagement. It does not require the practitioner to verify the accuracy or completeness of the information provided by management, nor to gather evidence like in an audit, even for something like revenue completeness. The practitioner relies on management's representations and the information they provide. Therefore, the suggestion from the team member is not proper because verifying accuracy or completeness is simply not a requirement or objective of a compilation engagement under SRS 4410. So that directly aligns with option C. While financials shouldn't be misleading, the method to prevent that in a compilation is raising known issues, not doing proactive verification procedures like an audit. Options A and B wrongly apply audit thinking, and D is wrong because ethical and qualitative requirements always apply. So C it is.
Okay, clear. Issue 3. It is also suggested by this team member that even though it is a compilation engagement, quality control aspects like adhering to appropriate standards needed to be followed. Which statement is relevant here? Options. A. SA 220 is applicable in this engagement and has to be followed by the engagement partner meticulously. B. SQC 1 is applicable in this engagement. C. Both SA 220 and SQC 1 are applicable in this engagement. D. SA 220 and SQC 1 are not applicable in this engagement. However, SRS 4410 lays down detailed quality control requirements for such type of engagement.
Quality control. This question is about the pervasive nature of QC across all professional engagements. The source explicitly states that SQC1, that's the overarching standard on quality control for all firms performing audits, reviews, other assurance, and related services engagements, is applicable to all engagement standards. Since SRS 4410 governing compilations is an engagement standard, SQC1 absolutely applies to firms regarding their compilation engagements too. The engagement partner is responsible for the overall quality and ensuring compliance with the firm's QC policies. Therefore, option B is the correct and most relevant statement. SA 220, while about quality control, is specific to audits of financial statements, so it's not directly applicable here. Option D is incorrect because SQC1 definitely applies. So B is our answer.
Perfect. Issue 4. It comes to your notice that figures relating to setting up of a new unit have not been properly disclosed. The expenditure was omitted to be shown under appropriate heads. You are vacillating regarding above, considering the scope of compilation engagement. What's the most appropriate statement? Options. A. The above noted omission can be misleading. By disregarding such an omission, the fundamental principle of integrity is violated and engagement cannot be performed in accordance with ethical requirements. B. The above noted omission can be misleading. By disregarding such an omission, the fundamental principle of objectivity is violated and engagement cannot be performed in accordance with ethical requirements. C. The above noted omission has no effect on performing such compilation engagement. D. The above noted omission has no effect on performing and issuing reports under such compilation engagement.
Okay, this scenario touches on that crucial ethical responsibility when compiled financial information is potentially misleading due to poor disclosure or classification. If the practitioner becomes aware that amendments are required for the financial information not to be materially misstated, or the compiled financial information is otherwise misleading, they shall propose the appropriate amendments to management. Disregarding such a material omission, especially one that makes the financial information misleading, would directly violate the fundamental ethical principle of integrity. Integrity requires practitioners to be straightforward and honest. You simply cannot be associated with information you know is misleading. Thus, option A is the most appropriate statement. While objectivity is also important, integrity is the one most directly and fundamentally violated here. Options C and D are unequivocally incorrect. An omission causing misleading information always affects the ethical performance of the engagement. It has to be A.
Right, integrity is key there. Okay, last one, issue 5. The team has prepared detailed documentation during the course of engagement. Which of the following statements is most appropriate regarding the assembly of the final engagement file? Options. A. Final engagement file should be assembled in not more than 60 days after the date of the report. B. Final engagement file should be assembled in not more than 120 days after the date of the report. C. Final engagement file should be assembled on a timely basis after the engagement report has been finalized in accordance with the time limit set by the firm. D. There is no requirement of assembling a final engagement file in a compilation engagement.
Okay, documentation assembly. The practitioner is indeed required to include specific items in the engagement documentation for a compilation, supports the report, shows compliance. Now, while SRS 4410 itself doesn't specify a fixed number of days for the assembly of the final file after the report date, it mandates documentation must be maintained. However, general quality control standards, specifically SQC1, which we've established applies, guide the assembly period. SQC1 generally requires timely assembly as per the firm's own policies and procedures, typically within a reasonable period. Often firms set this around 60 days, but it's firm-specific policy, not a dictate of SRS 4410. Therefore, option C is the most practical and generally accepted approach under broader quality control standards. Final engagement file should be assembled on a timely basis after the engagement report has been finalized in accordance with the time limits set by the firm. Options A and B might reflect common firm policies but aren't universal requirements from SRS 4410 itself. And D is flat out wrong. Documentation and assembly are absolutely required. So C fits best. Hashtag tag outro.
Wow, that was a truly comprehensive deep dive into related services for your exam preparation. Seriously thorough. We've meticulously dissected SRS 4400 on agreed-upon procedures, emphasizing the precise reporting of factual findings and, crucially, the absence of assurance. Then we thoroughly navigated SRS 4410 on compilation engagements, highlighting the practitioner's essential role in assisting management with preparation, but without verifying accuracy. And we wrapped it all up by tackling that real-world exam-style case study to cement those concepts and show you exactly how to apply them, making sure you really understand the nuances.
Absolutely. The key takeaways for you, as you prepare for your exam, are definitely the distinct nature of these engagements compared to assurance engagements, the very specific and non-interchangeable reporting requirements for each, and the unwavering importance of fundamental ethical principles, even when independence isn't a strict requirement like in AUPs. Understanding who takes responsibility, the practitioner, for the execution and reporting of AUPs, and management for the compiled information and its underlying basis, that's also paramount. Distinguishing these services clearly is key for your exam.
Exactly. So what does this all mean for you moving forward beyond just passing this exam? Remember, these aren't just theoretical concepts for a test. They're about professional responsibility, ethical conduct, and clear communication in the real world of financial practice. The distinctions between these services aren't mere academic points. They define the scope of work, the level of reliance users can place on the output, and frankly, the professional liability of the chartered accountant.
And that leads to a fascinating thought, doesn't it? How might the increasing complexity of financial transactions and the growing demand for specialized non-assurance services continue to reshape the role of the chartered accountant in the years to come? We're seeing a professional landscape that demands not just audit expertise, but also this versatile, targeted assistance, this area of related services. It's only going to grow in importance, I think.
Absolutely. The modern CA isn't just an auditor. They're an indispensable guide for businesses navigating their financial information, whether it's for compliance, internal decision-making, or specific transactions. Really vital skills. Until next time, keep digging deeper.